Hello. Welcome back to the continuing lecture and the financial statements. Now, in our last video, we discussed, basically how we arrive at the net profit. So, actually, the term you may wonder, you may have wondered. So operating, since you encounter at least two terms, right, with operating, the word operating in it. Actually, income statement is a description of the operating process, operating activity. What I'm saying is all the businesses engage in three types of activities. One is operating activity, the other one is financing activity, the other one is investing activity. And we can't go further into this, but operating activity is actually, the income statement process. So from so operating activity is actually the activity from starting from the process, starting from income, the revenue, and ending in operating income or operating profit, right? So then the steps after that is not part of the operating activity, but that explains why this profit is called operating income or operating profit, right? Of course, operating activity is critical in any business because they all operate to make profit, right? So anyway, then our although we stopped, we stopped at net profit, but actually there can be a couple of more steps or a couple of more actions. Actually, net profit, I've been telling you, net profit belongs to the owners, but owners don't get this distributed to them, right? Company doesn't pay it out to them. And I've been explaining why. It's because companies need to reinvest this profit, right? Companies need to reinvest it for its own growth. Now, as a shareholder, if you want to collect your own profit, right? Your share of profit, what do you need to do? All you need to do is simply sell your own stocks, simply sell your shares, and the shares, current share price reflects the profit. Why? If the company has consistently been making profits, significant profits, that will be reflected in the share price because in the market, everyone will try, it will be in high demand, that stock, that company will be in high demand, and everyone wants to buy that stock. So the price will automatically appreciate. Now, of course, sometimes it is over-evaluated in the market or under-evaluated. But assuming that the market's evaluation of this company is fair and just, unbiased, then the price will reflect exactly the increase due to the profit, right? But then, if you're not selling the stock, I mean, you can keep holding on to that. This is not the right time to sell yet, but but you still want to see some of it, some of the profit. Well, then company pays out dividends. Of course, I've been telling you, dividend is not an obligation, right? Dividend is only an option. It's not an obligation. So some companies may or may not pay out dividends. And if they pay out dividends, it's supposed to be some percentage of the profit. So they'll pay out. So think about it. Pay out dividend. You should have already seen profit. That means dividend is some fraction of the profit from the past. In other words, in the previous operating period. And what is the basic unit of operating period? Quarter, right? So from the quarterly profit, let's say, so the dividend, so we are in third, April, June, July. We still are in the second quarter, right? But at the end of July is the end of the second quarter. Now, but then think about it. If a company pays out dividend in July, in the second quarter, and oh, I'm sorry, we are in the third quarter because second quarter is April, May, June, and we have just begun the third quarter. And if we receive any dividend in the third quarter, it will be sometime around August, right? Sometime. But just because we receive dividend in August, that doesn't mean that's the dividend from the current quarter. Why? The current quarter has to end to calculate profit from the third quarter. Make sense? So what you receive actually in August is the dividend from the second quarter, right? Now, and companies cannot just pay out dividends immediately as the quarter ends, because first they will have to close the book, right? Compile the data, and they will have to calculate the profit or earnings. So usually, the beginning of the new quarter is usually called the earnings season. Why? Because that means companies are compiling their data and calculate the earnings of the previous quarter and release that information at the beginning of the new quarter. So that's the earnings. That's why early, like the first month of the new quarter is always called earnings season. And then actually the dividend gets paid out in the second month of the following quarter. So, so dividend is supposed to change with the profit level. I mean, because dividend is some percentage of the some percentage of the profit. Let's say it's called dividend payout ratio, and if dividend payout ratio is 10%. That 10% will, the calculated result of that 10% depends on the profit, right, of the previous quarter. So it is supposed to change with the profit, but in reality, dividend is only a token amount. It doesn't even change. Usually it's a constant amount. Because in reality, they pay out dividends based on the expectation, forecast of the profit at the end of the year, and you just divide it by 4 and pay out quarterly dividends. So it's not necessarily based on the past quarter's performance. I mean, theoretically, it is supposed to be that way, but they just pay a fixed amount, right? In reality. So suppose, they pay out dividend, and this is a positive number. And if you subtract that dividend from net profit, then it's called retained earnings. Now, suppose they don't pay out dividends. If they don't pay out dividends, as soon as 0, then the entire EAT, earnings after taxes, is the retained earnings. Make sense? All righty. Then let's move on to the balance sheet. Okay, let's move on to the balance sheet. Let me. Usually, balance sheet. Oops, I'm sorry. Okay, so usually the balance sheet is it can be put, I put it side to side, but it can be put, top to bottom. What I'm saying is, okay, first of all, I've been telling you that the balance sheet is not about the profit, but it is about the capital structure. Okay, capital structure. But then, what is capital structure? In a very simple term, capital structure refers to the composition of capital. In other words, how much of the total assets came from equity, and how much of it came from debt or liabilities. Now, think about it. In this example, total assets, right, is almost, let's call this, $10 million, just. Okay, 10 million. Actually, this would, all the numbers are expressed in thousands, okay, numbers in thousands. So this is more like, 10 billion. Now that makes more sense because so this is like, it's not 7, it's 10. Let's assume that this is 10 billion. Now, so first question. So where does that 10 billion go to? I mean, why do they need 10 billion in the first place? How do they raise 10 billion? And the second question is, 10 billion, most of it is, and we still assume this in our computer manufacturing, like Dell. So in any manufacturing, right? I've been telling you the most salient feature of manufacturing is the plant and equipment. Okay. So, and then land and building, right? Plant and equipment and land and building are significant part of the significant, capital need, right? You need capital to. So suppose the plant and equipment, land and building is 9.5 trillion. This plant and equipment is also called fixed assets, or real assets, or physical, because they are literally physical in nature. Real assets, also called real, or non-current assets. And non-current assets. Now, here's the term assets, right? So if you look at the balance sheet, right, and for manufacturing, a big part of the balance sheet is non-current assets or physical assets, and relatively smaller portion is called current assets, and current assets are all liquid assets or financial assets, right? So in other words, non-current assets are fixed, physical, real, right? Whereas current assets are generally financial assets. So they are listed in the order of liquidity. Okay. So from highest liquidity to the lowest liquidity. We talked about liquidity already in the previous topic, right? And it can be defined in on 3 levels, right? First, a very basic level, how easily it can be turned into cash. Second, cash flow. Third, money supply. So it's not difficult to understand what cash and cash equivalents are. They are highly, cash is most liquid. Cash equivalents are very liquid short-term debts. And marketable securities, yes, but part of the marketable securities are like stocks and bonds. Stocks and bonds. Bonds are relatively not changing in value that much, right? Of course, bonds also change, in price, but the swing, the range of fluctuation isn't that. Stocks fluctuate a lot, so stocks are not considered cash equivalent, because to be considered cash equivalent, it has to maintain steady value like cash. Now, and I will get back to promissory notes and accounts receivable later, but That already explains, how liquid, right, current assets are. And the term current actually is, I think current means present. Yeah, that's true. But in this context, current means running, right? Running. Now think about it. Liquid assets, a liquid runs, right? It can easily change hands, right? Like cash, cash can change hands, most liquid assets. Compared to the non-current assets, plant and equipment is hard to liquidate. I mean, it's not impossible. It may take years to liquidate, right? So in other words, as opposed to the current assets, which is running. I mean, literally, it means current means in English language, the only way you can associate it with running is like the current stream in the water, right? The current in the water, right? Obviously, that means the flowing, running of the stream, water, like Gulf Stream. Actually, French, current, French for current is courant. Courant means running, literally. It's present progressive, as opposed to current assets. All the non-current assets are fixed, right? And they take a lot of time to liquidate. Now, but think about it. Because out of 10 billion, right? I mean, you need at least 9.5 billion for the plant and equipment, and then 0.5 billion, the remainder, is you need it as current assets. So total capital requirement is 10 billion. Okay, so how did they raise 10 billion? How did they raise 10 billion? So if you think about it, there are only two sources, right? Two sources of capital, two sources of funds. One is debt, and the other one is equity, right? Equity is, we know that it is owner's capital, meaning that suppose we are starting up this company, right? Then there must be original owners or shareholders or partners. And so they chip in, original shareholders chip in, let's say 4 billion, right? And then because total capital requirement is 10 billion, then 6 billion must be raised through debt. So, and debt is called liabilities, right? Okay, this one here, liabilities, right? This is almost 6 billion, right? Consider that 6 billion. And debt can be raised in, debt can be classified into either long-term debt or short-term debt, right? Long-term debt called non-current liabilities. They fall into two categories. Either bond. You borrow from the bond market, or you borrow from the bank, mortgage loan. But mortgage is usually requiring some collateral, right? So obviously this mortgage is for buying building and land. I mean, I artificially match them If you got $3.5 billion in mortgage, what was that for? For building and land, right? And then, they sold $2.25 billion worth of bonds. And the rest is current liabilities. And I'm going to come back to current assets and current liabilities later. But this is, basically, by looking at this, you can tell this $10 billion total assets came from 60%, because $6 billion came from debt, $4 billion came from equity. So their capital structure is 60% debt to 40% equity. I'll have to. All righty. Okay. That's what is meant by capital structure. And it is a very critical indicator of how likely is the company to default. But, by any common sense, it's easy to understand that as this capital structure is skewed more to debt, for example, 40% equity and 60% debt is already significantly leveraged. Leverage means use of debt, which means default risk is significant. I mean, it's obviously you can tell the company is not likely to default if the capital structure is 10% debt and 90% equity. Make sense? But as the debt ratio goes up, if the debt ratio is like 70%, and capital structure is 70% debt and 30% equity, this company is already in very severe financial distress, right? Meaning the burden of servicing the debt is very high. It's called, financial distress. Suppose it is, 90% debt and 10% equity. Most likely, all of its earnings will be all eaten up by paying debt, right? Paying interest and principal, and so capital structure is a very important indicator. So now we're going to come back in the next video. We'll need to define what assets are, what asset is, right? Okay, so that's it for now. And I'll see you guys in the next video. Stop recording.